to the Q4 FY19 earnings conference call of LIC Housing Finance. We have with us Managing Director and CEO Mr. Vinay Saha, Chief Operating Officer Mr. Siddharth Mohanty, and Mr. Sudipto Seal, who is the Deputy CFO, to discuss the Q4 FY19 results. I now request Mr. Saha to take us through the key financial highlights for the quarter, post which we will have the Q&A session. Over to you, sir.
Good morning and welcome to the post-earnings call of LIC Housing Finance Limited. As you would be knowing, LIC HFL declared its Q4 FY19 results on Saturday. Before I go on to the highlights, introduction to Mr. Siddharth Mohanty, who has joined about a fortnight back as Chief Operating Officer with us in LIC Housing Finance. This is part of a succession planning which LIC HFL has devised, which will happen during the course of this current financial year. The key highlights of the results are as follows. Revenue from operations up 20% to 4,655 crores as against 3,888 crores for the corresponding quarter. Outstanding loan portfolio growth of 16.13%. It goes up to 1,94,646 crores as against 1,67,467 crores. Individual loan portfolio growth is around 14%. And it has gone up to 1,81,569 crores as against 1,59,350 crores. Disbursements showed a growth of about 7% and have gone up to 18,649 crores as against 17,402 crores for the previous year. Disbursement in the home loan segment clocked a growth of 18% during the quarter and stood at 12,248 crores. Net interest income showed a growth of 21% and it has gone up to 1,201 crore as against 989 crores. NIMs were at 2.54% as against 2.44% for Q4 FY18 and 2.33% for Q3 FY19. PBT clocked a growth rate of 21% and has gone up to 986 crores as against 813 crores last year. PAT for the quarter stood at 693 crores as against 594 crores, showing a growth of 17%. The board has recommended a dividend of 318%, that is rupees 7.60 per share. The fourth quarter of financial year 2018-19 brought to close one of the most eventful years for the NBFC and particularly the HFC sector in the recent past, wherein an unprecedented situation triggered a liquidity squeeze of a severity that we have not seen much often. The situation has eased considerably thanks to the initiatives of the government and regulatory authorities and is likely to normalize soon. The fourth quarter was one of the best quarters that we have seen in terms of our core home loan segment, which clocked a disbursement growth of 18%. As compared to Q3 of this year, that is sequentially, our disbursement clocked almost a 46% growth with a 33% growth in home loans. Project loan disbursements for the quarter stood at 2,031 crores as against 2,266 crores for the corresponding quarter of the previous year. We have continued to take selective exposure with good quality projects. Amongst the regions, the eastern and the east central regions, central and north central and southeastern regions registered impressive growth. On the affordable housing front, under the PMAY CLSS schemes, the company has registered an outstanding performance. For the full year, the company has disbursed about 38,000 accounts under this scheme, accounting for nearly 19% in terms of numbers, and have received a subsidy of nearly 1,000 crores for the beneficiaries. The company's strategy of opening large number of offices and creating regional centers in those locations has delivered good dividends. The company also plans to augment its reach by opening 9 more marketing offices in the current year, once again the thrust being in Tier 2 and Tier 3 locations. Another initiative taken by the company was introduction of the direct marketing executive channel, which has generated more than 700 crores of business this year. On the portfolio growth front, the total portfolio recorded a consistent growth of 16%. Prepayment rates continue to go down and they are now at 3%, 3-year low. In terms of asset quality under Ind AS, there has been an increase in stage 3 exposure at default, which has increased by 33 basis points from December 2018 levels, that is from 1.25% to 1.58%. mostly on account of transition from stage 2, which has shown a decline of about 56 basis points from 4.93% to 4.37%. Moreover, the stage 1 accounts, that is the standard assets, has shown an increase by 23 basis points, thereby indicating that the increase in stage 3 is more of an aging of the stage 2 accounts. No specific trends were observed in this transition, which has led to the increase in stage 3 ratio. Asset quality has always been a focus area for us, and the company has always delivered a very strong performance on this count. We are treating this rise with utmost urgency and placing it in the order of highest priority, and are confident of improving the asset quality in a couple of quarters. We have a zero tolerance policy towards NPAs. On the cost of funds side, though there has been a sharp increase in the interest rates in the system following the liquidity squeeze, we were able to contain the increase in the cost of funds to a considerable extent. During the quarter, the weighted average cost of funds has increased sequentially by a negligible 4 basis points only. However, we have been able to offset the increase by passing on the hikes on the asset side. During the quarter, the company hiked its PLR by 10 basis points, making it a total 70 basis points PLR hike during the current fiscal. The overall spreads have, as a result, shown a year-on-year increase of 22 basis points, resulting in an increase of 21% in net interest income for the quarter, and an increase of 10 basis points in NIMs to 2.54 for Q4. Liquidity continues to be good. The company has raised nearly 15,000 crores of NCDs during Q4, in addition to other sources like CP, bank loans, etc. With this brief introduction, I would like to invite you for your queries. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mahrukh Adajania from IDFC. Please go ahead.
So, hi, if you could explain the accretion to your developer NPLs. I mean, did they rise because these companies were dragged to NCLT, and which region are they from? Are they from the NCR region, and how would they be resolved?
No, currently we don't have any account which is there with the NCLT. So, consequent to that exposure to such companies which are already there with NCLTs, there is nothing. The accounts that have gone, there will be some 2-3 accounts totaling to about 150 crores or so have gone into NPS.
And those are from which region would they be from? Are they from the NCR region or?
A couple of them are from South.
Okay.
Yeah.
So it's not from NCR?
No.
Okay, and so just one more question on asset quality. What happened to retail asset quality? Usually in the fourth quarter, recoveries are very strong, but this time there's been a significant accretion to NPLs. So, what explains
as I said, the defaults in a very large proportion in that category retail, that is very surprising to us also. They have shifted to default because of aging, some delayed payments were there, 2-3 months delayed payments were there, which usually do not slip in such large numbers. So maybe because the market liquidity is such, and across the market, these things are happening. We feel it's an industry-wide phenomena which has hit us also.
Got it, sir. So, but is there any geographic bias to these slippages, or they've slipped all over?
No.
Okay.
I can only say that in fact in parts of UP, Uttaranchal, Hyderabad, Telangana, the performance has been very good. There, such slippages are not seen. But other than that, all across the country, it's observed all across the country.
Got it, sir. Okay, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Akash Datani from HDFC Securities. Please go ahead.
Hello.
Yeah.
Good morning, and thank you for taking my questions. So my first question is on the core home loan growth. So, where do you see this going? Hello?
Yeah.
So your outlook for core home loan growth?
We actually, last year, overall, when we targeted 15 to 16% growth rate for disbursements, which included core plus non-core both. So therein, what we have got this time, going ahead also, we will target the same growth rates, about 15%, and we will try to achieve this more by the expansion of offices that we intend doing. About 9 offices to be opened.
Okay. So is it fair to assume that the core home loan growth would continue at the current levels?
Yeah.
Okay. And my next question is on what are the yields and cost of funds for the quarter?
Cost of fund for the quarter was about 8.53%.
Okay.
And yield was about 10.3, 10.4.
Okay, so and your outlook on the margins, as in where you see them going from here?
Margins, see, it's very difficult to say, frankly speaking, because the borrowing cost
will inch up, I'm assuming.
But more or less, it should. For our company now, it is very stable around the same percentage of 2.4, 2.5. If we would try to improve it by maybe 5 basis points or 10 basis points, something like that.
Okay. And so in the individual NPAs that you all have reported, could you provide a split up between the core home loans and LAP?
1 second. The core loan was about 0.9%, and non-core was about 1.5, 1.4, 1.5.
Okay, that's it from my end, sir. Thank you very much.
Thank you. The next question is from the line of Anirban Sarkar from Principal Mutual Fund. Please go ahead.
Hi, thank you, sir, for the opportunity. Just one question.
Mr. Sarkar, may I request you to be a bit loud, sir?
Yeah, is it any better? Am I audible?
Yeah. It's fine, sir. Anirban is fine.
Yeah, okay. So, thank you for the opportunity. My question is that I think there has been a shift in provisions that we are holding from stage 3 assets to stage 1 and 2 assets. So, this is a bit surprising in a quarter where we have seen NPAs actually going up. So, is anything changing on the assumption side on your stage 1 and 2 assets? Are you expecting higher LGDs, or what has led to this, need to move the provisions more to stage 1 and 2 rather than maintaining our PCR on stage 3 assets? If you could help me understand that, math, it would be very helpful.
See, this is Sudipta here. See, actually, if you look at it, what we just mentioned, that most in the opening remarks, what our MD mentioned is that most of the NPLs that have happened, that is stage 3, is mostly a transition from stage 2. So we are expecting upgrades from stage 3 in the next very near future. So that is one of the reasons why, you will probably, if you compare it with a December or September number, you will find, this trend.
Yeah, so that's what I'm saying. I mean, if it has passed from stage 2 to stage 3, then the provisions would also pass from stage 2 to stage 3. Am I right?
Yeah, that is correct. That is as per the ECL model being adopted. But there also, if you look at the nature of transitions which have happened, there is a room for upgrades from stage 3 to stage 2.
Okay, all right. Fair enough. Thank you, sir. Thank you, and all the best.
Thank you.
Thank you. The next question is from the line of Kunal Shah from Edelweiss. Please go ahead.
Yeah. Sorry, just to again come on the question of breakup of individual NPLs. So you highlighted it is 0.9 and 1.4. So how much was it in Q3?
Q3 was... it was... individual was 0.76. Yeah. And non-core was about, say, 1.38, 1.4.
Okay. So just want to get the sense, this would be largely the salaried ones on the individual side. And normally in Q4, we see a significant decline. So what would have led to this, maybe in terms of, even though it is transitioning from stage 2 to stage 3, but what would have actually led to this kind of a delays, because we are not seeing it across the industry?
No, see, Kunal, I do not know whether it is not being seen across the industry, but the fact is that there has been some deterioration across the board. So that is the resultant, and we are very confident that these are more. We have interacted with the set of customers, and we know that this is not a very hard bucket. So that is the reason why again and again we are trying to convey that this is mostly a transition which has happened from the stage 2 to the stage 3, and it is across salaried, non-salaried both.
Okay, so any specific? So it's not like salaried is not moving and non-salaried.
No, it is not like that.
Both of them, both.
No, it's not like.
And how much would be the interest income reversal on account of this rise in GNPLs?
There is no reversal per se, because now
interest income. Maybe you would have not booked it. So I just.
So there is no reversal, no. It is not booked. It is not booked. There is no reversal per se.
Kunal, I hope you appreciate that the increase in the growth rates in the income have happened despite of these levels of NPAs. And no, I appreciate your concern on the NPAs, but I can assure you that in the company there is a much bigger concern and much bigger activity going on around now to see that this gets back to much lower levels, and we plan to do it within two quarters.
Okay. No, the only thing was my stance was, in fact, margins would have been much better. I would say normalized margins would have been better, but just because of the rise in GNPLs, actually we had seen only 21 basis points. So I just want to get the sense, like, actually,
true, that is correct.
how much would have margins moved up, okay, and what would be the normalized margin had this rise in GNPLs wouldn't have happened?
Kunal, number one, please don't say only 21.
Yeah, no, so I agree. It's a sharp rise.
There is Kunal, just to give you some sense of the numbers. See, for example, if the NPLs had been lower by, say, about 300 crores or so, 300 or 400 crores for a quarter.
What's the trend?
Huh?
Which is normally the trend in Q4.
Which is normally the trend between a Q3 and a Q4, around 200 to 300 crores, which is about a 500 crore variation from now. So at a yield of around 10%, you can easily calculate the kind of impact that would have had on the income.
Okay, cool.
Average yield of 10%.
Sure. Okay. And overall, in terms of the growth, given the slackening competition, how do we see it? Maybe are we seeing the benefit? Maybe on the core home loan side, we have seen the growth of almost 17-18 odd %. And on so one is, maybe do we see this traction continuing? And what would be our stance on LAP going forward? Is that segment which we are pursuing to be relatively more risky, and maybe the growth out there would be still muted?
No, coming to your second question first, the LAP growth rates are what we have experienced not only in Q4 but also for the year. They are basically at par kind of performance as far as LAP goes. Home loans, yes, especially in Q4, the growth rates have been very good, much better than what we expected, much better than what the market reflection was, that probably the growth rates won't be these high. Going forward also, I believe, the growth rates or the disbursements have not improved only because some of the players are maybe disbursing less. But let me tell you this, that home loan front, none of the players are going slow. It's only on the bigger developer loans and other things that some of the players have gone into this thing. And secondly, as I said in my this, that we got good traction from the PMAY segment, affordable segment also.
Okay. And lastly, on developer, we will see this kind of traction continuing, or maybe given there is a rise in GNPL, we would be slightly...
No, as I see, I've been saying since the day I joined that on the developer loan, we are very selective actually. So all decisions are on a case-to-case basis. going ahead also, maybe not a 60-70% growth rate, but I mean, it's not out of our focus or something. So maybe around the same percentage. We would be targeting, current year we have done about 7,000 crores disbursement in developer loans. That maybe 8,000 or 9,000 next year.
Okay, so that might continue.
Yeah.
Okay, good. Yeah, thank you.
Thank you. The next question is from the line of Nilang Mehta from HSBC Global Asset Management. Please go ahead.
Thank you for taking my question, sir. This was regarding NPAs for your LAP portfolio, which you mentioned is at around 1.5. Looking at your LAP as a percentage of your book, which is around 15-17%, that means your LAP NPAs are almost running at 8 to 10% kind of a range. Could you explain that, sir? Seems pretty high considering historically we have said that our LAP book is very similar to a home loan book where we are just doing salaried low-ticket LAP, and hence the sharp difference between the NPAs in these two categories seems quite large. So can you just throw some light on this?
I didn't get you. 10% of what you said?
Sir, of the LAP book, if you said 1.5% is your LAP NPA, is it of the overall book?
No, it is of the LAP book.
Okay. LAP book, yeah.
So can you just give a difference why the both books are seeing such reasonably large divergence in terms of one is showing 90 bips, other is showing almost 150 bips, considering, both are salaried kind of underlying as well as low small ticket LAPs.
Yeah, what has happened is probably, LAP, usually the volume is bigger. So the same person having a housing loan and a LAP loan, if that goes into default, amount-wise, that will be more, actually.
I didn't get that, sir. Can you?
Yeah, see, the core, the same individual who has a core loan and who has a LAP loan, and this goes into default or goes into the NPA category, so the effect will be larger in the LAP portfolio. So his contribution to the NPA in core will be smaller and his contribution to the LAP volume-wise will be bigger.
Is it because you're saying the LAP ticket size is bigger versus...
Yeah.
Maybe in some of those specific cases.
And can you give some, because this NPA increase has been a few quarters in our phenomena, it's not new. I think so last Q4 also we had seen a similar trend. So it's been 4 quarters, and at every conference call, generally the explanation is we are looking at it, but it continues to deteriorate. So can you give some concrete, either data points to understand where these NPAs are coming from or what measures the management is taking to restrain them?
See, like I said before, in fact, in 3 of the regions, the NPA levels have come down. That's the North Central region, the East Central region, and the Southeastern region. So it's not that it has gone up everywhere. And as far as measures you are saying, I think in September Q2 closing call, I had said that we had specially set up a task force now. A separate vertical for recoveries was already there, but we have set up a task force which has gone down to the level of being a person present at the area office level. Now this is taking time. The manpower required for this we went into some recruitment also in November, December. So that is being put into place. So that is one of the major reasons why I said that these levels, I believe, are the highest ever that the company has experienced. And from here on, it will be a journey downhill only.
And is there, for learning from these experiences, has there been geographies, categories where incremental loans are not being written? Or profiles for which you have become more conservative in terms of incremental lending?
No.
What you have seen?
No. That
as we mentioned in the initial opening remarks, Nilang, there is no specific trend that you can attribute apart from the fact that maybe in some of the states it is a bit lower, and it is what I understand from whatever information available in public domain, it's an industry-wide phenomena which is resulting in a weaker asset quality across the board. But having said that, there are three things to be noted here at the cost of repetition. For example, the first point is there has been an improvement in the stage 1 assets, percentage-wise to the total of portfolio between December and March. So that is a positive fact. The second is that it is, rather than fresh addition of NPLs, it is more of a transition from the stage 2 accounts to the stage 3 bucket. So these are the 2-3 things that we have been able to observe and identify. But yes, certainly, as we mentioned, it is now, it has always been a focus of attention for the company, where we accorded the highest priority to asset quality, and more so at this point in time.
And just one last question is on developer NPAs, where we have been again guiding for recoveries, but nothing seems to be coming. So can you give us status on these loans which were close to recovery but still has not seen light of the day?
No, we have been there also, Nilang. I think in my last call also I made a point that given to us, we would not like any of the accounts to go into NPAs, but have some of the accounts having slipped into NPAs. The comfort that we have is that the security under each and every one of them is more than adequate. And chances are that whenever they get resolved, we would never think in terms of taking a hit as far as the principal is concerned. Most of the cases will get interest. But yes, as you said, recovery, seeing to it that the recovery gets faster, make it happen. That is something which we are working, and it's probably getting hit in some of the cases from the cash flow issues that the builders are also having that contributes to this. One big account, and I would not like to hazard a guess when it will be done, but one big account was very close to resolution again in Q4, but last moment hitch in one of the NCR accounts, though not very big, I would say. We had even got the OTS check and all, but then check bounced. So, such things happen which are delaying the process further.
Okay, sir. Wish you all the best. Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit a question to 2 per participant. If time permits, you may join the question queue for any follow-ups. Thank you. The next question is from the line of Adarsh from Nomura. Please go ahead.
So just wanted some, you've raised yields by 70 bips through the year. Can you just quantify when these hikes were taken, like at least for the last 6 months, the dates or the months where these hikes were taken?
See, the first one was from 1st of July.
For April.
10 basis points was 1st of April 2018.
Yeah.
Then it was
June.
August was 20 basis points.
Okay.
Yeah. October was again 20 basis points.
Okay.
And January was 10. April was also 20 basis points.
Okay. So broadly from the hikes perspective, the last hike was January. So effectively, most of your portfolio should be reflecting all the hikes. Is it like there is, as of today, whatever hikes you've taken is already baked into the yields? Is that a fair?
Full 70 basis hike was from 1st January on the full portfolio is what you can say.
Okay, right. So the point I'm saying is, apart from the mix shift change, you should not have a yield improvement going forward, given the kind of hikes that you've taken for now.
No, on a year-on-year basis, the improvement will still be there because these hikes were not there last year at this point in time.
Yeah, so I was just mentioning on more sequential basis that this quarter should have factored in the hikes. Okay, understood. And how do you all define stage 2? Is it like any account due between, say, 30 and 90 days, or is there subjectivity there, or what is the stage 2 definition internally? Like, how do you classify?
Generally it is, between 30 and 90.
Okay, understood. And last thing, I just wanted to understand on the funding side, you all have been able to get a lot of funding in the debt market on the NCD. Just wanted to ask, in the last 2-3 months, what's been the trend? What are you raising money at currently in terms of NCDs? Because when I look at NBFCs and HFCs, your mix in terms of NCDs have actually improved in the last 6 months after the crisis. So it's relatively commendable. But I just want to understand, at various points of time in the last 3 months, or at least not in the last 2 months, but beyond that, some of these funds were relatively more expensive. So if you can just walk me through why you raised that instead of, say, another cheaper source, if you can.
See, actually, there are some 2-3 different sources which is taken into consideration. The ALM also matters. For example, obviously, it is obvious that the commercial papers are cheaper, or probably the cheapest of all the sources. But for ALM purposes, we limit it to a particular extent. If you see, the commercial paper as a percentage of the total outstanding is around 4.5%, which was there around 5% as of December. And NCDs have increased, and the incremental cost of funds for the NCD piece has come down, I would say, quite significantly as compared to its peak in the October, where probably a drop of around 50 odd basis point also has happened. Depending upon the liquidity scenario in the economy, the rates will move, but it is quite confidently we can say that those rates that we had seen in the month of October, November are certainly the interim tops that we have seen, and we are raising funds around 30 to 40 basis points cheaper significantly as compared to those rates today.
So your cost of fund, you said, is 8.3 for the quarter. What was the, that's the full stock of your cost of fund. What was the incremental cost of fund?
8.49 is the stock. 8.53 was the for the Q4.
Okay, and what are you raising money today at, right? So I would guess today is better than January. So
yeah, today it is better than January. For example, today a commercial paper will be at least around 25 to 30 basis points cheaper than what it would have been in January. Same for the NCDs. So blended, assuming that we maintain the same composition of liabilities as we saw in the month of March, you can see around 20-25 basis points drop. Barring the bank loans has not become cheaper. The banks have reduced the MCLR, but it's only in the range of around 5 basis points or thereabouts. So apart from that, for the market borrowing piece, around 20-25 basis points could be the range.
Understood. Thanks, Aditya, and thank you, sir. See you.
Thank you. The next question is from the line of Utsav Gokewar from Investec Capital. Please go ahead.
Thanks for the opportunity, sir. Just a couple of questions from my side. This quarter, we have increased the share of DSA by around 300 basis points sequentially. So now DSA share is around roughly 21%. What actually drove this? Is it like we have seen a lot of balance transfer, or this is a new business, or any color on that?
See, probably the DSA has got clubbed with the DMEs.
What is that?
DMEs.
Last year we launched a new channel known as Direct Marketing Executives.
Mm-hmm.
So they brought us about 700 crores. So that may have got into the DSA thing, increase in that.
And how different it is? This is like, can you just help me to understand?
They get lower commissions on loans, and they are paid a monthly stipend.
Okay. And it works similar to the DSS, right? They can source loans for all the other companies too?
No. Because we pay stipend, they are wedded to us.
Okay. So secondly, my question is on the borrowing mix. So if I look at the cost of borrowings for NHB, for most of the players, it has improved. But for us, on a sequential basis, the cost of borrowing for NHB instrument has increased by around 20 basis points. Why is that so?
Because there were some low-cost borrowings which had run off on their own.
Sorry, I didn't get this.
There was some low-cost borrowing that we had taken from NHB which had matured.
Okay. And what will be our incremental rate then?
Incremental rate, we have got a 2,000 crore loan approval from refinance approval from NHB today, but we have not discussed on the rates. but it should be thereabouts in the market range of market, maybe 10, 15 basis points here or there.
Right. And sir, I assume, what is the yield on project loans this quarter and last year? Because I assume it has declined both on a YOY and quarter-on-quarter basis.
See, the project loans last year. Hello?
Yeah, I'm here.
For the last year, it was on a non-annualized basis around 12.5, so you can take it as slightly more than 13%. That was as of 31st March 2018, and actually it has remained by and large at. I would not say that there is too much of divergence from there. It is about, say, 20-25 basis points lower this year. Sorry?
What is the reason? Because I assume you must have increased the rates on project loans as well, right?
So here also, it's a combination of both these two factors. First of all, what you've said is that incremental, whatever loans we had given, probably would be higher incrementally. But the stock also contains some of the high cost loans which have run off on their own.
Okay.
And more importantly is that this time around we have focused significantly on the category A+ kind of builders, where obviously because of the strength of the builders, the pricing has been much finer.
Okay, cool. And sir, last question.
Sorry, Mr. Gokhale, okay. May I request you to join the question queue for any follow-up?
Sure.
Thank you. The next question is from the line of Nischint Chauhate from Kotak Securities. Please go ahead.
Hi. So your reported yield on loan has gone up from 10.45% to 10.53%. And I believe 10.45 was for the whole of 9 months, and 10.53 was for the entire year. So, I mean, mathematically, it would mean that your rise in lending rates would have been much more in the fourth quarter per se. So we were just trying to understand as to what has really happened over here. The second thing is that if I look at the line item on your footnote on loss of modification of loans, that has actually been around 18 crores in the fourth quarter of last year and around 70 crores in the fourth quarter of this year. So if I add back that loss, then technically a margin expansion is again on a year-on-year basis or even on a quarter-on-quarter basis a lot more. Yeah. So we just wanted some clarity on this aspect.
I think that the second point that you noted regarding the notes footnote, that is something we had discussed earlier also, but again just to reiterate, wherever there is a permanent change or decline in the earnings of a particular loan, that has to be factored in. So that is something which is there as
part of... So you actually repriced some of the loans, is it? Because the loss is 70 crores in the fourth quarter versus around 15 crores in the first 9 months.
Yes. So that is one thing.
Then how does the margin expand despite that?
So the margin has expanded because that 70, what we were referring to just a few minutes back, the entire 70 basis points impact has only come from the 1st of January. And the margins also is a factor of the cost of funds. There was a very sharp rise in the cost of funds between Q2 and Q3. But from Q3 to Q4, it has remained by and large stable to a declining trend. So the margin got captured there itself. It is a combination of both these two factors. Mostly I would say in Q4 the play is on the liability aspect, apart from the fact that the full 70 basis points impact on the asset side got factored in.
No, but there was some benefit of the 70 basis points in the third quarter also, right?
True, but the margins could not get fully released because the cost of fund incrementally for the third quarter, if you just recollect the October, November, December quarter, had been very high.
So, if I look at the weighted average cost of funds, it's just gone up around 4 basis points. Sorry, it's just gone down.
Incrementally, that is between December and March. But if you see between June, your actual comparison should have been between September and December, where it had increased by 15 basis points.
Sure. Can you share the exact number of home loan disbursements for the fourth quarter?
Yeah, it is there on the press release, but just to repeat, it is 12,448.
Okay. And what was the NPL in individual and non-core loans in the fourth quarter of last year?
0.4%.
That was in the fourth quarter last year.
Yeah. And 0.56 non-core.
Sure. Just one question again, just one last question. How often do you reset your PDs and LGDs?
See, the PD and LGD with respect to the ECL model, as we discussed in the third quarter earnings call, that was almost like a work in progress because that was a new thing which we had adopted. And during the course of the year, we had reset the model maybe once. After introduction in the first quarter, again it went through a change in the third quarter. Then thereafter it has been stable. There has been no change, and unless there are fresh instructions from the government or from the regulator, there will not be any further changes.
So then incrementally it would be like sort of, the PD and the LGD rates would be sort of, let's say, set up for the entire year now for FY20?
Yeah, unless of course there is any change in regulatory or instructions from the government.
Sure. And just one last clarification on NPLs, you don't book any interest income, right? I mean, some of your peers sort of book interest income and then they make a higher provision.
It is not there.
So do you book interest income or no?
On which one?
On NPLs, after migration to Ind AS, what most of your peers are doing is that they are recognizing interest income, and at the same time they are making subsequently higher provisions. While in IGAP, in the previous guidelines, they were not recognizing income on NPLs. So when you have implemented Ind AS this year, do you recognize any loans on NPLs and make subsequently higher provisions, or do you not recognize income at all on NPLs?
No, but the recognition is done, but higher provisioning is also done.
Okay. So any movement in NPLs?
Mr. Chavate, may I request you to join the question queue for any follow-up, sir?
So just one clarification, any movement in NPLs does not affect margins at all?
No.
Okay, great. Thank you.
Thank you. Before we move to our next question, we'd like to remind the participants to limit their question to one per participant. If time permits, you may join the question queue for any follow-ups. Thank you. The next question is from the line of Viral Shah from Credit Suisse. Please go ahead.
Yeah, hi, sir. Thank you. I had one question. So I was looking at the repayment rates in the builder segment. That seems to have come off quite sharply this quarter from some 6.5% levels to 3% levels. And same has been the trend even for the individual segment.
Yeah.
So could you comment on what has been the reason for such a sharp reduction, especially in the developer segment?
See, the prepayments are a function of primarily two things. One thing is that the interest rates and liquidity in the system, and obviously the intensity of competitiveness or competition in the system. So the prepayment rates which were there earlier were in a different kind of a liquidity scenario and competitive scenario. Now they have changed.
Right, and even in the builder segment. So,
yes.
Okay, and there hasn't been any what you call slippages because of that?
No, it is not slippages because of prepayment rates.
No, the overall repayment rates.
No, I'm not getting your query actually.
So the overall repayment rates have sequentially come down meaningfully, and your NPAs in the developer segment has also increased. So
no, that has nothing to do with prepayment. Is completely different. Prepayment is premature payments, premature repayments. They are not connected to what you're saying.
Okay, right. Thank you.
Thank you. The next question is from the line of Jignesh Sahil from MK Global. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah, please. So just continuation to what earlier has been asked, just needed the clarity that in case of NPLs happening in an account, you recognize the interest as well as you increase the provision. Am I understanding it correct?
Yeah.
Yeah, and the reason for lower credit costs and lower provisioning is because this quarter is because you're expecting stage 3 additions, whatever has happened, we'll see an upgrade probably in this particular financial year. So the LGDs has been lower, and that's the reason why the provisions have been lower.
It is based on a certain model which takes into account the trend and also the recoverability. Right. It is based on, as compared to NHB, which was a historical behavior. This is a predictive model.
Understood. And just confirmation, two more confirmation, you're expecting 15% sort of a growth for next financial year, and your developer finance book should grow, should do around 8,000, 9,000 crores sort of a disbursement.
Yeah.
Am I understanding correct?
Yeah.
And margin should in the range of 250, 254 bips, what you did, should remain in a similar range, because that should remain stable for next year.
Yeah.
Perfect. Thanks a lot, sir, and all the best.
Thank you. The next question is from the line of Shivranshu Mishra from BOB Capital Markets. Please go ahead.
Hi, sir. Thank you for the opportunity. Wanted to understand the disbursement in the construction finance segment. So how many accounts, and are these fresh sanctions, or these are like more like evergreening of accounts, and how many have been acquired from the present due to the present liquidity crunch that we have, sir?
See, as I said, developer loan segment, we did about 7,000 crores of disbursement.
That's for the
year. For the quarter, it was 2,000 crores.
True.
This was less than what we disbursed last year by about 200 crores. Last year was 2,200 odd crores.
Right.
So it was out of this, you can presume about 50-60% was from was a takeover. About 40% was fresh.
This is for the full year, you're saying, sir?
Quarter.
Quarter, 60% was takeover.
Yeah.
Okay.
And about 40% was fresh.
Right.
Yeah.
And sir, how many? And the number of accounts that you have disbursed in third quarter and the fourth quarter, sir? And the average ticket sizes as well, sir.
This is on the builder side or on the
builder, sir. Builder.
Okay, just a minute. Total disbursements.
Yes.
I would say that 7,000 odd crores, 7,000 odd 128 crores.
Yes.
Is spread across 105 disbursals.
Okay.
That could be part disbursements also of earlier loans.
Okay.
Because the 7128 also includes part disbursements of loans which we had started disbursements last year also.
Right. So what I'm trying to allude to is what is the incremental disbursements or number of accounts that you have done in the third quarter and the fourth quarter ever since the advent of the liquidity crunch. That's what I'm trying to get at.
Okay. Third quarter and fourth quarter incremental disbursements should be in the range of around 65 to 70 units. Around 60 units. Hello?
Yes, sir.
And that is the approvals. Maybe out of that, maybe around 45 to 50 would have got disbursed.
Okay.
And the disbursements last two quarters put together, Q2 and Q2 was around 2,000 plus crores. Q3 was around 1,200 crores. Q4 is around 2,000 crores again. So that is 3,200 crores.
Right, sir.
For the third and fourth quarter.
Right, sir. And the average ticket size?
Maybe request you to join the question queue, sir. For any
just one last question. The average ticket size for construction finance in the third quarter and the fourth quarter, sir?
Third quarter, fourth quarter, the average ticket size will be in the range of around 45 to 50 crores.
Both 45
yeah,
to
average, yeah.
Sure, sir. Thank you so much.
Thank you. The next question is from the line of Sandeep Jain from Birla Sun Life Insurance. Please go ahead.
Yeah, hi. Thanks for taking my question. Just want to understand this provisioning and predictability of the expected loss model. So if I look at the numbers from 1Q FY18 to till date, right, our stage 2 from 5,000 to 8,500 kind of, and stage 3 from 1,000 to 3,000 kind of, right. And despite that, in this quarter, the provisioning line item is lower compared to the earlier quarters kind of. So, just if you can make us understand that what highlights this expectation of the provision kind of.
See, the important part that again, at the cost of repetition, if you have to see the improvement which is there in the stage 1.
So the stage 1 in this quarter is also related to the disbursement of this quarter, is it not true?
No.
Okay.
It is an overall improvement. So that would have been there in the previous quarter as well.
Okay.
So if you say that it is there in this quarter, then it would have been there in the previous quarters also. So everything is there in the portfolio. So the stage 1, 2, 3, if you look at the stage 1, there is an improvement. And the improvement is also not very small. It is about 20-25 basis points of improvement. And so that actually will arrest further creation of stage 2. Am I getting it? No?
No, I understand. Okay. So because if we compare to Q2 FY19 to 3Q FY19 also, the same amount of increase in stage 1 was there and the similar amount of increase. So stage 1 there is a recovery, but stage 2 is also deteriorating, right?
No, it was not there. Between Q2 and Q3, stage 1 had actually fallen. Between Q3 and Q4, there has been an improvement. I can read out the numbers if you want.
No, it's fine. Okay.
Yeah. Actually there had been a declining trend from after June itself. Okay. From March, it had the stage 1 had come down from to June. From June to September, there was a further reduction. From September to December, there was an even more reduction. It is only in Q4 where there is an improvement of around 22-23 basis points between December and March in the stage 1 account. Whereas if you look at on the stage 2 had been steadily rising till December. Now it has fallen.
Okay. Yeah. So that gives you confidence that the provision can rise.
Yes.
Fine. Thank you.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential AMC. Please go ahead.
Thanks for taking my question. I want to understand what kind of loans are you taking over? You did about 1,200 crores of disbursements in the developer loan segment this time, right? BT loans. What kind of loans are they? What is the nature of takeovers?
See, all the takeovers are in construction finance. Some of them are in the lease and discounting LRD area. I would say that the skew is
how much in the construction finance and what kind of are you providing interest rate moratorium? You can just talk a little bit about that.
So that is as per the stage of construction. Whatever is there as per stage of construction.
Okay.
For example, in LRD there is no question of moratorium.
Not in LRD, I'm talking about construction finance.
Construction finance, whatever is the normal process that we are following.
The disbursements are as per the stage of construction. So even if we sanction 100 crores...
But why is he coming to you? Are you offering him a lower interest rate? Are you
sometimes, depending upon the nature of the project, but not always.
Okay. Thank you so much.
Thank you. The next question is from the line of Pandi Chala from B&K Securities. Please go ahead.
Thank you for giving the opportunity, and I'm sorry if I'm repeating the question. Just a data point, if you can share it. Incremental yields for the quarter as well as the incremental cost of funds?
The incremental cost of funds was around 8.53. Incremental yield was around 10.3 or thereabouts.
10.30.
10.35, 37.
10.37. Similar number for the Q3?
I will give it to you later on. Right now, I'm not having it immediately.
Okay, no issue, sir. Lastly, on the stage 2 assets, 4.38% which you have given, can you share the bifurcation between the two individual as well as the developer portfolio within that?
Just 1 minute. It is more or less mirroring the GNPA ratio also.
Okay.
In the bifurcation of the stage 1 to 3 of the of the project and the builders.
Oh, okay. So similar fashion which we are seeing in gross NPA will be in stage 2 as well.
Yes.
So any thought process, if you can share what steps we are taking so that this stage 2 should not move to stage 3?
That we have just discussed. If you want, we'll just repeat.
Yeah, I shared with you now regarding formation of a task force.
Okay.
Yeah.
Okay. Thank you, sir. Thank you very much.
Thank you. Ladies and gentlemen, due to time constraints, that would be the last question. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
Yeah, thank you for participating in this. This particular quarter, which was followed by Q3, wherein there was a lot of liquidity problem, but this particular quarter, the company has been able to do fairly well, I would say, in most of the parameters. We plan to build further on the income parameters in the coming quarters. NPA, the asset quality front also, we are very much concerned with the increase in the levels, but as I said before, the task force has been formed and we are quite sure that the levels will again come down to previous levels by a couple of quarters. Going ahead, the company plans to widen its spread. We would again like to strengthen the DME channel so that contributes more. the disbursement growth as also the loan book growth we are targeting for the next fiscal at around 15 to 16% in excess of that. Thank you, friends. Thank you very much.
Thank you very much.